Welcome back to the channel. Today, we're tackling a crucial topic: what investments to consider during an economic recession. With uncertainties in the economy, it's vital to know where to put your money to protect and even grow your wealth. Let's dive in. Treasury bonds. Investing in treasury bonds during an economic recession can be a strategic decision for several reasons. 1. Safety and security. Treasury bonds are issued by the U.S. government, making them one of the safest investments available. Investors trust that the government will honor its debt obligations, reducing the risk of default. 2. Preservation of capital. During a recession, stock markets often experience significant volatility. Treasury bonds can help preserve capital by maintaining their value or appreciating when equities fall. 3. Income generation. Treasury bonds pay interest every 6 months, providing a steady income stream. This can be particularly valuable when other income-generating investments may be underperforming. 4. Inverse relationship with stocks. Generally, when stock prices decline, bond prices tend to rise. This inverse relationship can help mitigate losses in a broader investment portfolio during economic downturns. 5. Lower correlation with other assets. Treasury bonds often have a low correlation with other asset classes, such as stocks and corporate bonds. Including them in a diversified portfolio can reduce overall risk. 6. Interest rate considerations. In a recession, central banks may lower interest rates aggressively in faster pace to stimulate the economy. As rates fall, existing bonds with higher rates become more valuable, leading to price appreciation. 7. Liquidity. Treasury bonds are highly liquid, meaning they can be easily bought or sold in the secondary market, providing flexibility for investors who may need quick access to cash. 2. Dividend stocks. Investing in dividend stocks during an economic recession can be a wise strategy for several reasons. 1. Steady income stream. Dividend-paying companies typically provide regular cash payments to shareholders, which can help offset losses from declining stock prices. This consistent income can be particularly valuable during uncertain economic times. 2. Financial stability. Companies that pay dividends are often well established with stable cash flows. They tend to have solid business models that can withstand economic downturns better than those of non-dividend paying companies. 3. Defensive characteristics. Dividend stocks are often found in sectors such as consumer staples, utilities, and healthcare, which provide essential products and services. These sectors tend to perform better during recessions, as demand for necessities remains stable. 4. Potential for capital appreciation. While the primary appeal of dividend stocks is their income, many dividend-paying companies also have a history of capital appreciation. Investing in these stocks can provide the dual benefit of income and growth. 5. Reinvestment opportunities. Many dividend-paying companies offer dividend reinvestment plans, allowing investors to reinvest dividends to purchase more shares. This can compound returns over time, especially in a recovering market. 6. Market perception and stability. Companies that maintain or increase their dividends during a recession often send a positive signal to the market about their financial health and management confidence. This can help stabilize their stock prices. 7. Lower volatility. Dividend-paying stocks tend to be less volatile than non-dividend-paying stocks, which can help reduce overall portfolio risk during turbulent times. 3. Consumer staples. Investing in consumer staples during an economic recession can be a prudent strategy for several reasons. Here's a breakdown of why it makes sense to invest in this sector during downturns. 1. Stable demand for essential products. Consumer staples companies produce and sell essential goods like food, beverages, cleaning supplies, personal hygiene products, and household items. These are products that people continue to buy even when their incomes are squeezed during a recession. Unlike discretionary items, consumer staples are necessities, so their demand remains relatively steady regardless of the economic cycle. 2. Defensive stock nature. Consumer staples are often referred to as defensive stocks because they are less affected by economic slowdowns. While other industries might experience significant drops in demand, like luxury goods or travel, consumer staples tend to maintain more stable revenue and profitability. This makes them a safe haven for investors during periods of economic contraction. 3. Lower market volatility. Companies in this sector usually experience less price volatility in their stocks compared to cyclical industries such as technology, manufacturing, or finance. Because their earnings are more predictable, consumer staple stocks often don't experience the sharp drops that more cyclical industries face during recessions. 4. Consistent dividend payments. Many companies in the consumer staples sector have long histories of paying dividends. These consistent dividend payments can provide income to investors during tough economic times when capital appreciation might be harder to achieve. Reliable dividends are a major attraction for investors seeking stable returns in a recessionary environment. 5. Resilience to inflation. In many cases, consumer staples companies have some pricing power. This means they can pass on higher production costs, due to inflation, to consumers by raising prices on their goods without losing much demand. Since their products are necessities, consumers are often willing to pay slightly more for them, providing a buffer against inflationary pressures. 6. Strong brand loyalty. Many consumer staples companies benefit from strong brand loyalty. Customers may opt for familiar, trusted brands during economic uncertainty, ensuring steady sales. This loyalty helps protect companies' market share even when consumers are cutting back on discretionary spending. 7. Safe haven during uncertainty. During times of market volatility and economic uncertainty, investors often seek out safe haven assets, and consumer staples fall into this category. When other sectors are suffering from declines in consumer spending and business investment, consumer staples tend to hold up better, offering investors a safer place to park their capital. 8. Potential for outperformance. Historically, consumer staple stocks have tended to outperform broader market indexes during recessions. Their ability to provide consistent earnings, dividends, and relatively stable stock prices often leads to stronger performance compared to more cyclical sectors. 9. Diversification benefits. Adding consumer staples to an investment portfolio during a recession helps balance risk. If the broader economy is contracting and other sectors are struggling, consumer staples can act as a counterbalance, providing stability and reducing the overall risk of the portfolio. 10. Recession-proof products. Products in the consumer staples sector are often considered recession-proof because people will prioritize spending on necessities, even in tough times. While they might reduce spending on luxury goods, entertainment, or travel, they will continue to purchase everyday items like food, toiletries, and cleaning supplies. 4. Gold. Investing in gold during an economic recession is a common strategy for several reasons. Gold is considered a safe haven asset, meaning it tends to hold or even increase in value during times of economic uncertainty. Here's why it can be a valuable addition to your portfolio during a recession. 1. Hedge against economic uncertainty. During recessions, the stock market often becomes volatile, and many assets lose value as businesses face declining profits and consumer confidence drops. Gold, however, is seen as a store of value that tends to remain stable or rise when other investments are underperforming, providing protection against market downturns. 2. Hedge against inflation. In times of economic downturns, governments and central banks often respond with measures like quantitative easing or lowering interest rates, which can lead to inflation. Gold serves as a hedge against inflation because its value typically rises when the purchasing power of fiat currencies declines. Investors turn to gold to protect their wealth from eroding during inflationary periods, which are often linked to recessions. 3. Safe haven asset. Gold is considered a safe haven asset because it tends to perform well during periods of uncertainty. When investors fear stock market volatility, currency devaluation, or geopolitical risks, they often seek the safety of gold. This demand drives up the price of gold during recessions, making it a strong performer when other assets are declining. 4. Diversification benefits. Adding gold to an investment portfolio during a recession can help diversify risk. Gold often moves inversely to stocks and bonds, meaning it can provide a buffer against losses in other asset classes. This diversification reduces the overall risk of a portfolio during economic downturns. 5. Protection against currency depreciation. During recessions, some countries may experience currency devaluation due to lower economic output, trade imbalances, or excessive money printing by central banks. When currencies weaken, the relative value of gold increases. Investors turn to gold as a way to protect against the declining value of their domestic currency. 6. Tangible asset. Unlike stocks or bonds, gold is a physical asset that you can hold in your hands. Its tangible nature gives investors peace of mind during times of economic uncertainty, as it is not subject to the same risks as paper assets or electronic financial systems that could fail or lose value in a recession. 7. Limited supply. Gold's supply is limited, and it cannot be artificially created. This scarcity, combined with its historical significance as a valuable asset, contributes to its resilience during economic crises. Unlike fiat currencies that can be printed, the supply of gold is largely stable, which helps protect its value. 8. Strong historical performance during recessions. Historically, gold has outperformed other asset classes during recessions and periods of financial market instability. For example, during the 2008 global financial crisis, while stock markets plunged, the price of gold surged. This historical track record adds to its appeal as a safe investment during economic downturns. 9. Protection from negative interest rates. In some recessions, central banks may implement negative interest rate policies to stimulate economic growth. In such cases, holding cash in the bank may actually cost money due to negative rates, while gold, as a non-yielding asset, becomes relatively more attractive as it doesn't lose value simply from being held. 10. Global acceptance. Gold is universally recognized and accepted as a valuable asset, making it a global currency of sorts. This makes it highly liquid, meaning it can easily be converted into cash in virtually any country. In times of crisis, when financial markets are uncertain, this global liquidity provides security to investors. 5. Utility stocks. Investing in utilities stocks during an economic recession can be a strategic move due to the following reasons. 1. Defensive nature of the sector. Utilities provide essential services, such as electricity, water, and gas, which people rely on regardless of economic conditions. This means the demand for these services tends to remain stable even in recessions, making utility companies less vulnerable to economic downturns compared to other sectors. 2. Stable cash flows. Utility companies often operate under regulated environments, ensuring steady cash flows from their customers. This predictability allows these companies to generate consistent revenue even when consumer spending in other sectors declines, which can offer protection during recessions. 3. Dividend payments. Utility companies are known for offering attractive dividends, making them appealing to investors seeking income during periods of economic uncertainty. The steady income from dividends can provide a cushion when stock prices are volatile, which is common during recessions. 4. Lower volatility. Utilities stocks are typically less volatile than other sectors because of their stable business model. During a recession, when market volatility tends to increase, the lower volatility of utilities stocks can offer a safer harbor for investors looking to protect their portfolios. 5. Interest rate sensitivity. During recessions, central banks often lower interest rates to stimulate the economy. Utility companies tend to benefit from lower interest rates because they are capital-intensive businesses that rely on debt financing. Lower rates reduce their borrowing costs, potentially improving profitability. 6. Safe haven in uncertainty. Because utilities are considered essential services, these stocks are often viewed as a safe haven during economic uncertainty. Investors tend to flock to defensive sectors like utilities when economic growth is weak,